tools of monetary policy. Monetary policy refers to the actions undertaken by a nation's central bank to control the money supply and achieve macroeconomic goals such as controlling inflation, consumption, growth, and liquidity. So, monetary policy is tumutukoy niya siya sa mga actions sa nga gihimo sa central bank sa usa ka kanang lugar or kanang bansa nga para makontrol nila ang kanang kwarta o kanang ilahang maabot ang lang gusto nga layunin nga macroeconomic parehanin kanang pagkontrol sa pagtaas sa presyo or unsa pa o kanang growth.
So the next one is open market operations. In open market operations, the Federal Reserve Bank buys bonds from investors or sells additional bonds to investor to change the number of outstanding government securities and money available to the economy as a whole. So the objective of these open market operations is to adjust the level of reserve balances to manipulate the short-term interest rates and that affect other interest rates.
Next is the primary tools of monetary policy. These include first is the open market operations. Open market operations involves the buying and selling of government securities in the open market to regulate the supply of money. So the purpose of this is to buying securities increases the money supply and stimulates the economy, while selling securities decreases the money supply and curbs inflation. So open market operation is like kanang mubay bitaw ang kanang mupalit sila aron ibaligya pod.
Let's go with the discount rate. Definition: the discount rate is the interest rate charged by central banks on loan they give to commercial bank. It is a discount rate refers to the interest rate the central banks charge commercial banks on loans they provide to them. It is also a tool used by central banks to regulate the money supply in the economy.
The third primary tools of monetary policy is reserve requirements. Reserve requirements are regulations on the minimum amount of reserves that banks must hold against deposit. The purpose of reserve requirements is that lowering reserve requirements allows banks to lend more, increasing all the money supply. Raising reserve requirements reduces the amount banks can lend, decreasing the money supply.
So this is scenario 1 situation. The economy is experiencing rapid inflation. Questions: which tool should the central bank use to address this issue? So the central bank should consider selling government securities in open market operation to decrease the money supply or raising the discount rate, maybe borrowing more expensive. Increasing reserve requirements will also be effective in reducing the amount of money.
Scenario 3 situation: banks are reluctant to lend to each other, causing a liquidity crunch. Question: which tool should the central bank use to increase liquidity? Answer is the central bank should lower the discount rate to encourage banks to borrow more money from the central bank and increase lending. It might also consider buying government securities to inject liquidity into the banking system.
Scenario 4 situation: this is moderate economic growth but inflation is slowly rising. So question: which tools should the central bank use to keep inflation in check without stifling growth? The central bank might consider a modest increase in the discount rate to prevent overheating without significantly impacting economic growth. Selling a moderate amount of government Securities through open market operation could also help manage the money supply.
So, this is Nico Pagnanawon and this is scenario number 5. This is a situation. Consumer confidence is high and spending is increasing rapidly. Question: which tool should the central bank use to prevent potential inflation? Well, the tool that the central bank will use to prevent potential inflation is the central bank should consider selling government securities to reduce the money supply or increasing the discount rate slightly to temper borrowing and spending. Adjusting reserve requirements could also help, but it might be used less frequently for fine tuning. Tuning to be rather.
So, conclusion. By using the above worksheet, students can practice identifying the appropriate monetary policy tools for various economic scenarios, deepening their understanding of how these tools influence the economy. By using the above worksheet, students can practice identifying the appropriate monetary policy tools for various economic scenarios, deepening their understanding of how these tools influence the economy.